Marketable securities relate to investments that companies own that are publicly traded. So there's a readily available stock price. You can get an idea of what the fair value is of that investment that you own, but not all investments that companies own are publicly traded. So non-publicly traded investments are considered non-marketable equity securities. And those are just the prices of investments that have no publicly available stock price, and companies do make a lot of their investments in non-publicly traded companies. So think of Google and Apple. They might invest in companies that are in a late round financing stage. So think of companies like Tesla before it did its IPO. There might be investments in those types of companies, and we'll still want to look at what's the impact of that on a company's balance sheet and income statements. And keep in mind that with the rules changes, so looking at the top chart, after 1/1/2018, your realized and unrealized gains. So remember, your realized gain is the gain that you have once you sell an investment. You physically sell it, so you've realized the gain. Hopefully it's a gain. Unrealized gains relate to the investment value has increased in value, but you haven't sold it yet, so you haven't realized the cash and the gain from that investment. For marketable equity securities and non-marketable equity securities, so think of that just generally as public and private companies, any unrealized gains hit your income statement once that investment increases in value. The other thing to keep in mind is that if there's a loss, so if the investment in that company, if that company's value has declined in value, losses will still automatically have to be taken on the company's income statement, decrease the value of your investment on your balance sheet. That's always been around, that hasn't changed. But when we're looking at has your investment increased in value, and if you haven't sold it yet, you have potential unrealized gains, even if you have a non-marketable equity security, those increases should still be quantified on the company's balance sheet, and the unrealized gain should be on the company's income statements. So companies, the new standards require companies to report this at fair value, so report your investments at fair value. But if we think of the ability and practicability of a company being able to report those investments at fair value, if there's not a readily available price, so the listed stock price, it's going to be hard for companies to value those investments. And what the rules give is they allow a practicability exception, which you would be allowed to hold your marketable security, so your non-marketable security investments, at cost, so the original cost that you acquired that investment at, and you would be able to include it at cost plus or minus any observable price changes. So this means we're looking for market-driven valuation events. So maybe a company that you held that was originally private did go public, and now you can get an idea of what your investment's actually worth. Or maybe the company issued more shares in another round of financing, so you can get an observable market event in terms of what your asset might be worth. It's a really complicated analysis that you have to go through, and keep in mind a lot of subjectivity to it. So it's hard to be able to figure out what your true fair market value is, and companies can fall back on the practicability exception and say it would be too costly or have too much subjectiveness to trying to figure out what the fair market value is. So we're just going to hold that investment at cost. Keep in mind they'll still definitely need to impair those investments, and your auditors will review your financials to see if potential impairment needs to be taken if your investment in the company is not worth as much. But you can fall back on that exception if it's just you're unable to be too costly, too timely to figure out what on earth this investment is worth. So companies can also invest in debt securities. So companies might purchase debt securities in order to get an additional form of interest income coming in for the company. And companies can purchase debt securities in the form of corporate bonds. So if bonds are issuing debt in order to raise funds for the company, cash for the company, you can see them in terms of government bonds or municipal bonds. These are all forms of debt that other companies can invest in to get future streams of interest income. And companies typically classify their debt securities or their debt investments based on 3 buckets. So the first bucket is looking at our trading securities. And what this means is that you don't expect to hold that debt instrument for the entire length of that instrument. So maybe the debt is going to be outstanding for a few years and you only want to hold it for a few months. You don't intend to hold it for the full 3-year term length. That any increase or decrease in value for that investment. And keep in mind, we always impair our assets or take a decrease for any of our investments on our balance sheet if they need to be impaired. That's always automatic. But if there's an increase in the fair value of that debt security, and if it's considered a trading security, so the company never intended to hold that debt security for its entire life, the changes in fair value or the increase in fair value of that debt security is reflected immediately in current income. So that would follow exactly what we look at for our marketable securities for equity. So if I have unrealized gains, if that security has increased in value, that unrealized gain automatically increases the asset value for the security on my balance sheet and automatically is shown as an unrealized gain, a positive thing on my income statement. So keep in mind my debt securities that I'm holding for a short-term length, I'm trying to make either a quick profit or just get some interest income from that, follows exactly how we account for my marketable equity securities. Available for sale debt securities. What this means is that if there's changes in fair value, so if there's a change, an increase in the amount or the value of that debt security, that change in fair value or that unrealized gain doesn't hit my income statement, so no impact, no increase to net income for unrealized gain. I house the increase in fair value on that debt security in an equity account called accumulated other comprehensive income. So we do not go through that in this lecture. We don't talk about what gets housed in AOCI. But what I want you guys to know for an available for sale security, for a debt security, is that this is a debt security that the company intends to hold on to for a while, but they intend to dispose or sell that debt security before the end of its maturity date. So let's say the debt was going to last 5 years, or the life of that debt, the maturity date was 5 years from now. The company will hold on to it for more than 12 months maybe, but they're going to get rid of it before the end of the 5-year life. And if that debt security increases in value in the market, you're going to increase the asset value for that debt security. So the investment will increase as an asset value on your balance sheet. The increase won't go to unrealized gain on your income statement. The increase will just be an offsetting increase to equity on your balance sheet. Once the company physically disposes of that debt security, then that unrealized gain would translate into a realized income statement item. It would increase your gain on your income statement and be realized upon the sale. Finally, what we have are held to maturity debt securities. And these are debt instruments that sound just like the title. The company intends to hold on to them until their maturity dates. We hold those maturities typically at cost. And when we actually dispose of the maturity, when the maturity is the 5 years is up, for example, what we're going to do then is any fluctuations in fair value would be recorded in current income upon that sale. So with held to maturity securities, there's no change on our balance sheet for the value of that maturity if there's any changes in fair market value. The company is basically just holding on to that maturity until the life ends on that maturity. And we're just earning interest income historically as we hold that maturity. There's no changes in balance for fair value on the balance sheet or the income statement. So this is what we'll see for how a company holds or values their debt maturities on their balance sheet. Keep in mind, the main thing to take away here is that for trading securities, if we think we're going to sell those debt securities pretty quickly, changes in value are immediately impacted on the balance sheet and the income statement. For held to maturity securities, there's no change in value typically recorded on the balance sheet or the income statement. The maturity sits at whatever the value is of the maturity on that date, and there's no impact on the balance sheet or the income statement until the life ends on that maturity.